right, welcome everyone. This is the Global Macro panel. I'm David Sheng, your host. I myself am actually a reformed macro hedge fund allocator myself, but for this panel, we have an excellent group of macro investors, allocators, and hedge fund managers. We only have 30 minutes, so I think we're going to focus mostly on the role of macro within an alternatives portfolio. And anyone who wants to take up the panelists on a debate around inflation, the dollar, you can meet us in the rum room in the afternoon. All right, so why don't we start with intros? I'll turn it over to the panelists to kind of give a little bit of background about your firm, scope your hedge fund portfolios, and your business. So, Christian.
Thank you, David. Christian Dery, I'm the head of macro strategy at CFM. We're a Paris-based systematic manager. We run almost 17 billion AUM at the moment. We apply the scientific method to markets. We're founded by physicists in 1991. We have over 100 researchers with backgrounds in the hard sciences. The structure of the firm is very flat, so we don't have any pods. All the researchers collaborate. And the design of the firm really is all the research is conducted in our flagship fund, Stratus, which is actually closed with a wait list. But all of that research just propagates out to other strategies. So currently, we're managing a new multi-strat. We've got a global macro fund and then 2 trend funds, one of them with some defensive features.
Pablo?
Oh, yes. So Pablo Calderini, I'm the CIO, president of Gram Capital. We roughly have 20 billion AUM, and we have about 70, 75% in quantitative systematic, so where we apply the scientific method to macro markets mostly, and then 25% is where we have discretionary PMs, so we call that the discretionary fund. Different way of dealing with the same problematic, same markets, same issues, and to about 200 people. We have 4 offices. We just hit our 30-year anniversary. And
Nicholas?
Great, yeah. So I'm Nicholas Cormier. I'm a portfolio manager at Canada Pension Plan Investment Board, which manages about 675 billion Canadian dollars on behalf of working Canadians. Specifically, I work in external portfolio management, which manages about 10% of the fund and invested in public market hedge funds across all strategies. My role specifically is focused on systematic macroeconomic investing as well as support on the portfolio construction side.
Hi everyone, I'm Jackie Rosner from PAAMCO Prisma. I'm on the investment team and I focus on global macro and RV hedge fund strategies. As a firm, PAAMCO Prisma invests in all hedge fund strategies. We have a platform called Molecule, and we invest in, provide all sorts of hedge fund solutions for our clients. Really great to be here today. Big thanks to iConnections and MFA for such a great event. And where else can you go and get your 10,000 steps in before 9 o'clock in the morning? It's pretty amazing. And I want to definitely thank the conference organizers for an official limited edition conference tie with the logo and with the colors. I'm sorry my fellow panelists didn't get one, but anyway. And so many big hitters speaking at the same time here right now. So thank you for coming here in Grand Ballroom A. The other speakers have been relegated to ballrooms B, C, and D, but you guys chose well. Thank you.
Thanks, Jackie, for running it out. And yeah, no, we didn't get the memo about the tie, but we'll have to talk to iConnections. But thank you for sponsoring. And maybe I should just also quickly introduce myself. I'm David Sheng. I'm on the hedge fund team at Aksia. We're a global alts consultant. Hedge funds are part of our DNA. Spent a lot of time with the folks on this stage over the years. But why don't we talk a little bit about global macro, which is one of the more dynamic and tactical of the hedge fund strategies in the space. And but before we kind of turn to these implementation issues around global macro, I wanted to ask the allocators first. What are your thoughts kind of about the market environment overall for hedge funds? What kind of returns can investors expect over the next couple of years? Nicholas, you want to start off?
Sure. Yeah. So I think from our perspective, forecasting strategy is extremely difficult thing to do as a starting point. So we really focus on allocating across a breadth of strategies, high focus on diversification. But in terms of looking forward, I mean, you think about the global economic backdrop right now, you have China struggling economically. You have US exceptionalism, which has been a hot topic throughout the conference so far, and then you have developed markets, which have been downshifting kind of in between. So there's a lot of fundamental dispersion for macro strategies to take advantage of and capture. So I think like we're constructive on next year in terms of the opportunities available within macro. Broadly, hedge fund, like for a well-diversified portfolio, probably somewhere in like the cash plus 3 to 5 range, and that's with no exposure to beta.
Jackie, what do you think? Cash plus 3 to 5?
Yeah, I'd say
Is it a reasonable
hopefully
target?
even more than that, because given that cash rates are so elevated, and hedge funds for the longest time have been competing with the rally in equity markets and elevated cash rates. So we always aim for double-digit returns. That's always been the primary objective. It's an absolute return focus. I'd say the second objective is that try to manage it within reasonable drawdowns, and third is try to make it with like less correlation to equities. But the environment is very strong and hopefully capable of generating. One should aim for these double-digit returns because there's so many things going on in the markets. With the new administration and all the policy implementations across tariff changes, immigration reform, tax cuts, deregulation, the wall of worry is mounting. There's massive debts out there, mounting deficits, a strong dollar bid. There's a fear of China exporting deflation, geopolitical risk. Goes both ways. Elevated risk could be inflationary. If geopolitical risk goes away, it could be deflationary. There's so much volatility, and as investors are worried about the equity rally that's been so strong for so many years, and caution is warranted. People are worried about the duration risk as well. So there's going to be a lot of focus on active management, and so I mean, hedge funds should be a good year, a good environment for hedge funds for trading strategies. And it's definitely, especially leaning into positively convex strategies that are volatility friendly, hence the topics that we're going to be discussing today. For decades, traders have talked about things like don't fight the Fed, but now with the new administration, there's another mantra. People could say, don't fight Trump. This is, he's very vocal, very genuine, transparent about what he wants to do. And there's going to be a lot of movement in markets. Just like the Fed is data dependent, people say Trump is beta dependent. He's going to be also looking at wealth creation, levels of equity markets, but things are not going to be going up forever. So the fact that there is going to be volatility and trading opportunities, I think, gives investors a chance to be making more than cash plus 3 to 5 should be.
Okay. Well, thanks for setting the stage there with the macro backdrop. Why don't we dig a little deeper and just talk a bit about kind of global macro, different styles, and we can talk about use cases. But Pablo, I want to bring you into the conversation. Graham has a significant macro business across kind of both discretionary and systematic macro. Can you just talk a little bit about the contrast in the two styles? What are the pros and cons and how you approach macro?
Sure. So they are not that dissimilar. We are looking at the same markets, liquid markets. The signals come mostly from, say, fundamentals. So you look at things like fiscal, monetary policy, huge amount of focus on monetary policy, central banks, fiscal dynamics, growth, inflation, and then some signals that you can classify more as factors like value or mean reversion or carry. But overall, I would say the difference is the methodological approach that you use to get signals from this data, right? So on the quant side, we have the sort of luxury of looking at a huge amount of data. In particular, now we don't use unsupervised machine learning, but we do use a lot of machine learning methods. So you can look at a lot of data, right? Even if it's correlated. Multicollinearity in the world of machine learning doesn't really matter anymore because you can compress data well. We use a lot of pattern recognition, type of regression analysis on non-linearities in the data, which is very key to macro, and then very robust portfolio construction. So all those things are very germane to quant, right? And that's something that makes quant able to extract the maximum amount of data macro fundamentals, right, and make forecasts. But then it has to be rigid somehow, right? Because how do you inform a trading system that something happened over the weekend, for example, with an AI program, right, coming out of China, or that Trump said something about tariffs. And if you try to do that, I think you take a lot of alpha away from the program. So these programs sort of focus more on the 1 to 2 month horizon and get alpha from that big data compression and forecasting power. On the other side, PMs can be a lot more flexible, right? And you get like really deep, like well surprised about how a good PM is able to really get all the non-linearities and the dynamics of the data, right? It's like the example that I always give is you go back to your desk, and if you're a quant PM and something happened, geopolitical accident, what have you, you really are not going, if you're a quant PM, you're not going to react. And if you're a very good macro PM, you're going to understand that as a potential alpha signal, right? So pros and cons, I would say, even if you're a very good, very analytical, discretionary PM, you will never be able to have the kind of armament that we have on the quantitative side to look at so much data and process data so well. But then you have to be more rigid, right? And then if you're a discretionary PM, you're not going to be able to look at all that, but you have all the flexibility and the years of knowledge of how to react, so adapt a lot more. So in a nutshell, they have different horizons. So our quant programs typically run 1 to 2 month horizon, maybe 3 months. The normal average PM is more, it's not high frequency in any sense, but it's more week to week.
Why don't we turn to Christian? As a quant manager, maybe you can elaborate a little bit on kind of what the primary sources of edge you view in trading macro, and how do you kind of think about trading systematically in kind of single name equities?
Yeah, sure. I just realized that the title of the talk is "Who Wins." It's really not an us versus them discussion. I was a discretionary trader for a long time, so it's near and dear to my heart. But the way I like to, when I talk to investors, the way I like to describe it is humans are a small group of humans. They have a bandwidth problem. The analogy I like to use is the Air Force did a study on its pilots, and what they found is a pilot, an experienced pilot, can't focus on more than 7 gauges in an aircraft. Otherwise, the probability of a crash goes up. So typically with discretionary, it's very concentrated. Talking about macro specifically, it's usually just a couple ideas every year that generate most of the P&L. It's just a limited amount of bandwidth in a strategy like that. So if we look at a firm like CFM, we're ingesting 5 terabytes of data a day. The firm is already past 6 exabytes. And the way I would think about it is like you have a search space, and inside that search space, there's a collective of ideas that can come out of it to make money. So we're able to capture many of the things a discretionary trader does on the macro side, for example, but we're also able to ideate into many more places in that search space and then add a lot more diversity in our portfolios. So all of our strategies effectively have hundreds of these competing ideas embedded in the strategies. The other one I'd talk about, it's topical, is alt data at our firm has become extremely important. So in the last 5 years, I think more than 50% of our models are essentially relying on these large unstructured data sets. And I'll quote Eric Schmidt recently. Apparently this is actually incorrect, but he stated that all of civilization's data up to 2006 is about 5 exabytes. And now we create that data every 2 days. Okay, so the point is it's exponential and growing enormously. And the reality is like there's just not that many firms out there who are in place with like the technology stack, the investments, the experience to actually exploit it. So we're very excited about that as well at our firm. It's just no human can really, it just gets so abstract at a point that like no human really is in a position to fully leverage like these large data sets and exploit it for alpha effectively.
Why don't we turn back to the investor perspective for a minute? I mean, Nicholas, can you talk a little bit about how you think about the kind of portfolio utility of macro in your hedge fund portfolio for CPP's kind of overall plan, and then how has that kind of evolved over the years?
Yeah, so I mean, within the external management team, basically whether we're talking discretionary or systematic, the whole idea is to diversify away from traditional corporate security selection and into more asset selection, more or less. So within both strategies, you have a lot of relative value investing and really just trying to capture dispersion, more or less. And then on more the directional side of trading, really capturing trends and things that are going on. So in the systematic space, some of the things that Pablo mentioned, like style exposures to more sophisticated versions of carry, momentum, fundamental momentum, those are all very common. Whereas what we expect more from the discretionary side is much more like real convexity that comes out at the right time. And like Christian said, that might be only one or two big ideas, but if you connect on those in the year, you can have a great year. So timing and conviction are part of that as well. But in general, both of these strategies are just trying to diversify across asset classes, across styles, and across timing horizons.
Well, Jackie, there's a lot of hedge fund investors and probably some managers in the audience. So could you kind of share your perspective on how you approach manager selection? How you think about kind of strategy selection within macro space, and what are kind of the decision points for you?
Sure. By the way, I just got to say, it's a pleasure doing a panel with a Canadian because President Trump said we're supposed to be very friendly and welcoming. And
Jackie,
nice to
there's
Canadians.
two Canadians.
I don't know why he
panel.
said that, but what's that?
There's two Canadians on the
Two
panel.
Canadians, sorry, two Canadians.
We're clear.
So we're supposed to be, extra friendly. I don't know what he meant exactly, but anyway, it's a pleasure. This is me doing my part. Okay, so
It's the risk of a global macro panel. It's controversial here. So.
Thanks for the warm welcome.
Thank you. And if Trump were here today, he would acknowledge that this conference is huge and the greatest conference of all conferences, and thank the millions of you here in attendance today. So, no, but how do we look at it from an investor's perspective? So both strategies, both styles are very important. Investors like us use both strategies and portfolios for various reasons. We need it for strategy diversification. These strategies tend to be positively convex and vol-friendly and tend to capture the right tails appropriately. Even though they may do it differently, one by discretion and one by system, they both trade very liquid, global, diversified, but they do it differently. The discretionary manager, as Pablo said, has the flexibility and has different entry and exit points, but often in sizable large moves, they tend to be very similar and correlated. And that's the big distinction. An average good discretionary macro trader might have a Sharpe that's just under 1. That would be very good. But the average future strategy, whether it's trend or non-trend, has a Sharpe much lower, maybe something like 0.5. But the systematic managers tend to trade at twice the vol than the discretionary manager on average. So they both kind of end up as similar absolute returns, but they kind of get there differently. But the way we look at manager selection is similar to the way we look at underwriting all hedge funds. We underwrite the people and the process. We want to make sure that the investment process is something that's been tested and repeatable. We like to hire people who are experts in the field. We say that we like their expertise to be an inch wide and a mile deep. People who have this proven expertise, even though as a history of our firm, we also have invested with emerging managers. They still are people who have proven themselves, and we have an expression in the office that we don't like to pay for someone's tuition. If they want to learn how to do a certain style of trading or investing, they have to do it on their own dime. So by the time they come to us, it's someone that already has like a real track record and stuff. And in picking talking about systematic managers, there's a few things that make them different. Strategy mix within them, whether it's trend and momentum or the non-trend momentum stuff. The speed of their trading, people trade at different speeds and holding periods, and also the asset class mix. So if you choose only one manager in the systematic space, your experience as an investor could be vastly different from another investor who invested with a different systematic manager. So 1 year might be the year of the 30-day average hold manager that trades commodities, and 1 year could be vastly different. So we say in our systematic allocations, you need definitely more than 1 or 2 managers for sure, but definitely less than 10 because you put too many people, too much diversification, and you just water down the soup and you just diversify away the returns. So pick the people you like the best. concentrate them, increase them, over time as they've been tested. And I'd say that pretty much sums up how we look at hiring discretionary and systematic managers.
Can I just make one comment? Is that okay, David?
Of course, please.
Thank you. This idea of convexity that was brought up, it's interesting because it's really just a mechanical effect. So when you trend follow, that's going to emerge. So it just kind of contrasts like how we would do things. We're always trying to find. So, and Pablo kind of used the word weaponry, I think, about this sort of, the statistical weaponry. We're looking for these effects that are inconsistent with luck, essentially. But what we'll find is so for example, macro, you come up with an idea, you test it on our research infrastructure. A lot of the times because you want new information in your system, so you have this existing predictor set, and it won't go into production if it correlates with something else, right? And in macro, for example, you'll find many times that it'll correlate with like a cluster of trend following predictors, right? And that's not new information, so you don't want to include it in your portfolio. So one thing with discretionary traders is there's sort of like a benchmarking problem. You're just measuring them on their P&L, right? But at a firm like ours, we're able to really understand what's contributing to each of these ideas that are embedded in our portfolios.
All right, Christian, well, thank you.
Want to make a distinction about the systematic and discretion. Systematic has to remain systematic, and if someone were to override a system, then all of a sudden they're a discretionary strategy. So there's definitely
well, why don't we just touch on that?
Can I just, one comment on that? So look, it's not a label. We run a business, right? And even a high frequency firm, there's a metaphorical button with a human, right? Markets are non-stationary and they're non-linear. So at our firm, we think about that. We have a committee that I chair basically, and it's to deal with non-model risks, right? So you have these emergent risks. Could be regulatory changes, elections. We're talking about DeepSeek, for example. And all we'll do, because we're running a business, we want it to be sustainable. We're just looking in a forward-looking way, how these things could impact our different businesses, right? And then you're just looking to strike a better balance in your portfolio. So for example, we never override signals, but on rare occasions, we'll put constraints on our risk models. And ideally, that'll feed back into the system. You codify the logic.
Yeah. Well, just maybe before we went to the lightning round, Pablo, just on this point, how do you think about kind of tactical shifts in your discretionary business, and how often and when you have a big regime shift, how large does that regime shift have to be in order to actually change your process on the discretionary side?
Well, so I would say that's the key advantage of the discretionary business. So we talk about pros and cons. So the con, as I said, is that you don't have the ability to look at this huge amount of data that you can look in the quant side, but you do have the ability to make this very shift, this very maybe on the fly changes, right? And if there's a big tariff, or if there's a DeepSeek, or if you can completely change your view of what's going on in markets. And that, I think, is the key advantage of discretionary over every other strategy, right? So I don't see it as something that is problematic, but rather it's actually one of the key strengths of discretionary trading. I think on the quant side, and I agree very much with Christian as well. So we have a process. We don't like to override the process ever, but we need to understand that markets are highly non-stationary and that things can happen, and you have to have humans looking at things. And we have a daily risk meeting where we do talk about systems doing X, Y, and Z, and we want to understand as much as we can. I don't want that to become an impediment, because the more you go big data, machine learning, the less you're going to be able to understand what things are doing. But we still want to understand somehow how things are trading, and if there are massive disruptions, you can have the ability to make interventions that are not about alpha ever, but are about risk management.
Okay, so we've got less than 5 minutes. I'm trying to make this a true lightning round, so less than 10 words. Or alternative intelligence, AI, for effectively trading macro.
So we think it's a disruptive technology. We've actually, we're scientists, so we like to tinker with things. We found lots of novel use cases already. It turns out it's really good for classification problems. We're talking about, by the way, machine learning is, the original papers were written in the 1940s. So we've been using machine learning for 20 years. But the LLM is sort of the disruptive technology. Yeah, so it's useful for classification problems. It's, it's just a richer way to compress information on large unstructured data sets. So you can get much more context for sentiment signals. I use it for coding all the time, for example. We just, iterating, right? Because the technology is changing so quickly. And we think it's important, and it's important.
Okay. Yeah. I think that was 89 words, Pablo.
Maybe 35 words for me. Yeah, super important. Like Christian said, many of these themes were there before. Now they're in a collection, right? But techniques like singular value decomposition, data compression, pattern matching, what have you, they were there before, cosine similarity, but now we're using them in a cohesive way. The way that I like to think about it now is that it's phenomenal for alpha discovering. We don't like to use unsupervised machine learning. I think it has a huge, today, it's super prone to overfit, so to perform incredibly well in sample, but terrible out of sample. But to discover alpha, then we can converse and understand why that alpha is there. Great tool.
Totally useful, and at a minimum, going to help researchers find better alpha.
AI turns data into information. Data not properly analyzed is just data. AI helps get information.
Okay. Last one, 3 words or less. Biggest macro risk.
Fiscal trajectory unsustainable. Good.
I agree.
Definitely artificial intelligence just shaking things up.
Inflation, higher rates.
Okay, well, there you have it. I'm not sure if we have a unanimous winner on the discretionary versus systematic debate, but we'll have to continue that one next year. So how about a nice round of applause for the panelists? Thanks.